Well, I think one of the big takeaways of this trade war has been that there's uncertainty in the air and volatility has been rising. If you're still interested in having growth in your portfolio as you navigate that risk, what do? Let's bring in Matt Orton. He's Chief Market Strategist at Raymond James Investment Management to get his perspective on how to navigate choppy waters. Matt, it's nice to see you. I'm sure you've handled endless questions around what the tariff tensions mean for one's stock portfolio. How have you been approaching things?
Hey, good morning, John. It's always great to join you. And you're spot on. I was traveling to meet with clients all of last week, and tariffs came up in every single conversation. And it's interesting because I think there's different perceptions around how tariffs might feed into inflation based on political beliefs. But regardless of where clients sit, my main message to them is that you don't want to move to one extreme or the other. This is a market and environment where we don't know a lot of what's going to come that can whipsaw sentiment around the market. And instead, what we really need to be focused on are earnings and what are the tangible growth prospects for earnings going forward. So coming into this year, I've advocated for better balancing growth and value within portfolios, especially as GDP growth in the U.S. and many other countries are starting to slow. You want to find pockets of earnings growth in this market, and you can do so in dividend growth parts. You can also find opportunities, I would argue, in some of the mega cap names that are off 15 to 20% so far this year with very good fundamentals. So it's all about focusing on the idiosyncratic, the company-specific risks for your portfolio. And I think if you do that, there's definitely a lot of opportunities that still exist today that are much more insulated from some of those tariff worries.
Okay, well, I do want to get into some of those opportunities in a second, but the idea of going to extremes, which you referenced, just as an example, we have a call-in show. And this morning we had an investor who was feeling uncertain and as a result was not feeling confident about putting much money to work in the stock market and was also saying that they are sitting on a relatively large amount of cash. And I think one of the challenges for investors is when there's so much uncertainty in the headlines, it doesn't feel like a wonderful opportunity to put your money to work in what is ultimately in the short term a voting machine. But at the same time, interest rates have come down from their highest level. You know, you're not necessarily getting the same bang for your buck that you might have been just a year ago with shorter duration products that are more geared towards interest rates. So for you, what would be an extreme for an investor in this environment?
So I think the extremes, we've kind of seen it. Investor sentiment basically hit the lowest levels we've had in the past couple of years, which was even lower than we were during COVID. So investor sentiment is very, very low given some of this uncertainty. You've had massive pullbacks, I would say, in a lot of the growthier parts of the market, even if there is tangible earnings growth. If you were attached to AI and perceived to have any weakness around DeepSeek, your stocks were taken to the woodshed, irrespective of what the fundamentals actually were. So this is a market where there's a lot of opportunities being created on a reaction based on perceptions of how things might play out. And I've been spending a lot of my time going to conferences, talking to management teams of companies. And what's most important and the main message that I've received from a lot of them are for a lot of higher quality companies that have a lot of cash that they can put to work, they're making investments and continuing to invest in their business. They're benefiting from the fact that interest rates, or at least Fed funds, has come down 100 basis points from where we were a year ago. And so all of that sets up a good environment for companies that are able to be nimble and that might be a little bit more insulated from tariffs. So some areas I'm looking at, John, in the market right now that I think fit that bill. Larger banks. They have a large diversity of revenue streams that can come in, especially corporate lending, I think remains fairly strong. But importantly, volatility increases their ability to make revenues from trading operations. Smaller companies, as they get cheaper, are going to be acquired, so M&A business can go up. Another part of the market that's worked very well is gold. Gold is a hedge to portfolios. Gold miners have not reacted to the degree that I would think. They usually have a 3 times beta to the market. We haven't seen that, so I would expect there's still another 10 to 20% to go for some of the gold miners that have earnings leverage to this market. So those are just 2 examples of where investors can put money to work. And the final thing I would remind investors is that even given all of this uncertainty, 8 of 11 sectors in the S&P 500 are in the green so far this year, some almost pushing to double digits like energy. So again, there's a lot of places that you can put money to work and feel confident because it's all about the individual earnings trends supporting those sectors.
I'm really glad you made that point too, Matt, because here in Canada, obviously people are watching every headline out of Washington. Sometimes we feel like we're getting swept up in things we cannot control, but the Canadian stock market, as you well know, is still in positive territory this year because gold stocks, energy stocks, and some of the utilities have actually gained ground, even though investors have soured on things like tech stocks. So good point there. You talked about dividend growth. I would imagine if companies at the end of the day feel confident enough in their businesses that they're going to invest, that part of the boardroom dialogue is around investing in their stakeholders through things like growing the dividend. Is there any rule of thumb, like when you look at sectors, are there any areas of the market where you see more pronounced examples of a company or a sector being willing to increase its dividend?
So that's a great question, John. And I think when you look at dividend growth, there's just very high quality companies in general. Some healthcare names continue to increase dividends, especially on the HMO side, which have also been weak given some of the news around specific companies here in the U.S. But other areas of the market where we're seeing more dividend growth because of deregulation has been in the financial space. So bigger banks being able to increase their dividends as regulatory capital requirements start to come down. That has been a very encouraging story. And you always tend to see dividend growth in some of the stronger consumer-related names, especially consumer staples. I honestly don't love consumer staples because they feel a little bit expensive in this market, and the earnings growth just isn't there, and they're a little bit more susceptible to tariffs. So I'm looking at even some of the tech names where they've recently started to pay dividends, but you have rock-solid balance sheets, 50, 60, 70 billion dollars of free cash flow per year, and some of the larger tech names with good earnings growth going forward. So those, again, I think are up and coming dividend growth names where the absolute dividend yield might be lower, but the growth rate is still very high. Those are great names where you can insulate against inflation in your portfolio by getting that dividend growth and also capture both capital appreciation and the dividend yield component. So that part of the market has been working very well.
Some great points there on where to watch the dividend growth. Matt, thanks very much.